Hey guys, happy Friday, I hope you're doing well. This is an important topic that I think we need to talk about. This should help you understand the top-down structure more, and automatically avoid some unnecessary losses in the markets and of course, maximize your wins and strike rate. So, let's dig deeper into the order flow and in very simple, understandable terms identify what are some key signs of order flow, a time when we don't want to fight the wave, fight the one-sided pressure even if the execution time frames are suggesting a move. Keep in mind that this can very well turn into an optimal trade entry against you, if you're trying so to say blow against the wind. I thought that a good example would be this painting, where we can see two different things in one. I think some of you have already seen it somewhere before. The old lady or young lady illusion is a drawing, in which you can see either an old lady or a young one. You can see the old lady if you see the dark bit of hair as a fringe, and see the young lady's chin as the old lady's nose. The bottom of the young lady's neck is the old lady's chin. Why I'm showing you this? It's because the same thing is going on the charts every single day without us even realizing it. Markets are throwing paintings with 2 and sometimes even 3 meanings, and we don't know which one is true, so we go with our instincts and make a guess, but we don't want to be guessing as that's not what makes a trader successful even with the most amazing management system that there is. So now that you get the idea of what we're talking about here, sorry that the intro was a bit long-winded, there are a few key but at the same time simple factors that are always in play to help us recognize what's the hidden agenda of price delivery. Let's start with the one you already know. When the price is clearly respecting and rejecting, let's say, bullish PDAs and breaking through the bearish ones, that's easy to say that we're in a bullish order flow. Now the other sign we must pay attention to is the candle formation. A key giveaway are large range candles showing one-sidedness, leaving imbalance and breakaway gaps. Also, when there are candles with large wicks, and the majority of those long wicks are forming to the downside, what's happening there is, price is reaching lower just to go higher. These are stop runs into bullish PDAs. It means that price is finding support there, and we don't want to trade against that until we see a drastic market shift. Another factor is when we see very clear gaps in price. This specific example a lot of times happens on Monday mornings. In which direction price gaps, it signals pressure from the algorithm to deliver price to a specific higher time frame target fast. We don't want to trade against that unless we have a strong reason to maybe build a case for a quick scalp play targeting that gap. Now another major thing we already talked about, and something I try to constantly remind you, is that higher time frames is like a parent figure to price, meaning that a 60-minute order blocks effect will always be much stronger than the one on the 5-minute time frame. What that means is, if we have a 5-minute smart money reversal pattern going on, but that happened after price on the 60-minute just formed a high probability order block and a nice, strong imbalance candle to the downside, this bullish 5-minute smart money reversal pattern is a simple trap and is actually an OTE to the downside. Remember the old lady painting that we talked about earlier in this video? This is the exact same thing here. So, that's why we listen to the 60-minute time frame more than we do on the 15-minute and lower. If the 60-minute time frame is with us or it's neutral, that's when we have a green light to listen to the, let's say, 5-minute one, as the so to say parent figure is either allowing kiddo to go that way or it's just sleeping and lets you do what you want for that time. Hope it makes sense. Lastly, when we do expect price trade against the order flow and the general direction is when we're trading around specific times in the day when the market protraction usually happens, and as you guys already know, that's when price in, let's say, a bearish 60-minute order flow, 5-minute time frame will go higher just to then go lower. So it's basically a trap as we already discussed in other lessons. But I wanted to add this one as it's also an important factor of when price will usually trick traders to jump on the wrong side, especially as market protraction moves are impulsive ones. So, if you have a long position running from London kill zone, a smart decision would be to take some partials before the New York kill zone open, as during the first half of it there's a high chance to see a run against the position, which could also very well stop you for break-even if you entered at a bad price during the London session or have your stop loss too close to the action. So, that is that for today. Really wanted to discuss about this topic in more detail and talk about some new as well as some old topics here that can make or break your results. Hope everyone's having a great day and we will talk soon. Take care.